Happy Monday morning. It's 9 a.m. End of August. I've got a brand new financial model, full model. Got some stuff I've never added before, like a cap table and distribution details up to six investment rounds, varying months, varying amounts, varying valuations. Um, Really cool stuff. So this is a marketplace model, and it could be a marketplace or network. The key is you're just trying to model some type of activity where you have a facilitator, which is the business you're modeling, and that business facilitates transactions. They could be online, they could be offline, it could be anything. It could be a car auction where, you've got people selling cars, you've got people buying cars, and then there's obviously fees that go along with that. It could be eBay, it could be like kind of um, an online place where people buy and sell specific things. Like eBay is just kind of a general use case, but you could have very specific things. It could be like almost a stock exchange or an online brokerage. Really, it opens the door up for pretty much any business that has buyers and sellers and a facilitator, and the facilitator would be the business or the marketplace or network. So let's dive in. I'm going to go through each tab and explain how it works. So first tab here is the index. This is just a tab that explains what all the other tabs are about. So you can see each tab name, description, and then definitions. Then we've got the global controls. Oh, and before I get too far into this, note you can purchase this template. I haven't decided on a price yet. It might vary, but you'll see a link in the description box below. You can click through. It'll take you to smarthelping.com and you can purchase. Okay, so anyway, global controls here. So this is where you're going to put in the start year. This means the first day of the year you plan on starting the business, not the actual month of revenues. Because this goes out for 5 years, so in order to do a clean model, this even if you start somewhere during the year, which you'll have assumptions that can do that. This needs to be the first day of the year you plan on starting up. Next is the exit month. So this, you might not have an exit. Now an exit means, like if I pick March here, 2023, it means you're selling the business. And then you could do some revenue multiple, and then this is going to give you that multiple here of exit value. Then we've got financing, if applicable. So if you want to take out a loan, you could decide the month you're going to do that and all the terms, and that'll flow through to a schedule, debt amortization schedule dynamically, and flow through to all the financial detail tabs. Then we've got, I just put into here an equity requirement so you can see in general after you get all your investor funding, all your financing, this is going to be, it'll say cash surplus if you actually don't need to put any of your own money in. But if you are going to put your own money in, this is the minimum amount you're going to have to in order to cover the cash burn that is the forecasted. Now that obviously, if we raised like $5 million, you have a cash surplus, so you've got enough loan and investor money to cover all of your expected burn and startup costs and everything else. If not, then you got to put some of your own money in. So that's the global controls. We've got activity assumption. So this is probably the most important tab for the user that's doing this and this is picking out how your revenue is going to populate. So I did three main item levels, and that's just because it probably doesn't help as much if you only have one item type for one amount. So you can define a low, I just did a low, a mid, and a high here, and you could define their monthly transaction volumes. And also you can define their monthly transaction values per each one, low, mid, and high. You could pick the start month. You can see here if I did, say, March of 19, and I go over to my monthly detail here, you can see low-level items, March of 19, 10,000 a month for year one, 25,000 a month for year two. So if we go in here to the monthly, and notice you can see the exit year 2023. As soon as that exit year gets put in, everything zeroes out after that. So here we go. So you can see that first level of item is 0, 0, and then March it goes to 10,000. And if I adjusted that to say July, you can see here it doesn't start till July. So all of these work. This has all been tested. Everything has been verified to work with the assumptions as you change it. So you could change the actual amount per month you plan on transacting for each level of the month it starts. Then you could do a growth. So I just did like an annual growth rate here, and you could put in whatever makes sense for you. Could be zero, could be negative, positive, whatever. Um, so there's that. We've got our value per unit. That might not change as much. Then we have how you're actually going to make money as a network. So you're going to charge a network fee. And I've done a couple different fees. If they don't apply, you can simply zero them out. But I just tried to include every possible way that you might make money on this activity. So we've got the transaction, the fee charged to buyers. So this means um, if a buyer goes and buys something, they actually have to pay a little bit of a network fee. Then we've got the fee charged to seller. So this means the seller, they list something. If it sells, then they're charged a certain percentage of that sale. So you might have zeroed out one or the other, or both. You might not have transaction fees at all. There's other ways you can do it. So here I've listed also a percentage of items listed that actually transact. So this is actually I'm changing. This is units listed per month, because you're not. It's possible that there's more things that are listed than actually sold. So we were counting for that. So you've got these listings, and then you've got actual of the listings what actually transacts, because as a network you might charge just to list no matter if it sells or not, but then you also might charge another fee if it does sell, and so we're accounting for all that. You can see here the standard listing fee is 1.5% of the value. This is charged to the seller in order to list no matter if it's sold or not, so they have to pay this 1.5% no matter what. Then if it sells they have to pay this percentage. And where's my other, where's my driver here? Here. So, okay, so there's that dynamic. Then there's advanced placement. So this is if somebody wants to pay to have their whatever they're selling or trying to transact be above other people. And this might not apply. If not, you could just put zeros here, but basically it says the percentage of each item level that is going to be in priority, and then the markup that it costs to actually list such things. So this is again just going off the um, listing fee, and it's doing 50% of that as an additional advanced placement fee. Okay, so then we have ad revenue. This is the final stream. So this is if, you've got a network, you've got a lot of users on the network, you might want to sell ad space to third parties that they might not actually have things to buy or sell on your network or marketplace, but they might want to advertise on it for, whatever. If that's the case, you can do pick your start month for that stream. You can pick the expected monthly network visits, the growth each year of that monthly number, and then the average page views per user per month and the growth of that, and then your CPM, or how much you expect to make per 1,000 views. And based on that, you get derive a monthly revenue for ads. And again, that's dynamic. So that's your revenue. Next up, we have costs. Costs are pretty standard. This is how I like to do it because it applies to almost every situation. So you've got your G&A. You list your descriptions here. You can change all these. The start month, so you can scale into things, and then the monthly amount for each year. So this is saying the CEO is going to get $5,500 a month in year one, $5,500 a month year two, etc. You could obviously put in whatever numbers are going to make sense for your situation. We've got R&D, same deal. We've got marketing fixed. Now here's what I've done is I've added some spots for a marketing variable percentage. So this is going to be percentage of total revenue spent on marketing. It could obviously be zero if it doesn't apply. Pick the start month for all that. Then you've got cost of goods sold. Now you might have a fixed cost of goods sold that you can just enter. You know what the monthly amount is going to be over time, or you can estimate it pretty good. But then you might have a variable cost of goods sold, and therefore you've got a percentage of revenue for that too. So that covers kind of all the possible logic that you're going to need to try to forecast expenses of this marketplace in some way. And again, if anything does not apply, you can always zero it out, no problem. All right, next up is startup costs and Capex. So Capex is just, list your Capex items here, the months they disperse, and the amount of whatever you're going to spend. So this is like expansion stuff, server expansion, office expansion, one-time planned activities that aren't going to fit into any of the other places where you have cash disbursements at. And um, this will then flow through in a separate area and accumulate in your cash flow item lines. Then we've got startup costs. So this is just simply first a single amount that happens before you can even start operations. So it's going to be like your initial investments. And often this will merge, you'll have your initial investments, and then based on how you structure your revenue and cost, you could have some monthly burn that will also add up, and all that's included when we look at the actual equity requirement of the person starting the business or group starting the business. Um, which is separate from the investment requirement, or if you have investor money coming in, which we'll get to. So that's what that does, and I'll show you where that flows to once we get through to the monthly detail. Financing, here's just a schedule, standard schedule. Here's our cap table. Now the cap table is brand new. I haven't tried to do this in a model because I didn't really I thought it was too complex and too hard to track something because I've got these models being very dynamic on a monthly basis, and it's just hard to do. So this probably took me, I don't know, 3 or 4 hours to accomplish. And what it does is you've got basically six possible raises here, and it could be specific investors, groups of investors you plan on having, but there's six different spots here. You can pick the month the funding comes in, that flows automatically to your cash and financial summaries. You've got their investment amount, and then you've got what is going to drive their share of whatever the company produces in profits and or exit proceeds. So if you've got someone coming in at 500,000 at a valuation of 3 million, that's going to buy them 16%. Then let's say you have somebody, and let's just use the same number to show. Let's say somebody else comes in with 500,000 in April, and now you're going to value the company at 5 million. Well, the same amount is now only going to get them 10% ownership rather than 16. And the dilution comes from whatever's left for the equity. And this would also tie directly to this equity amount that's being put out. The remaining equity that comes back is based on whatever this percentage is after you've sold different things. So I put, cap table, how much of your company will you give away at what price? So obviously, the higher the valuation, the less you have to give away and the more money you can raise. Let's say you valued this only at 500, or let's say a million. Now you've actually given away 70%, you've only got 3% left, and it's not good. And you can see how this affects annual IRRs of each group and the equity um, of the starting equity that's remaining. You've got um, your total returned, your total ROI, and your annualized ROI. And obviously, annual ROI is different from IRR. IRR is really a discount rate that takes into account the time value of money. And because this was the hard part of building this is you could see these that different months, like if you fund in a different year, then your IRR basis is going to be different for when your periods actually start because your cash out period zero is you don't want to combine that with actually the like year three of cash flows. You want it to be cash out is period zero, and then any cash flows coming in the next the first year after you've invested is period one, and then and so on. So this was very difficult to make dynamic, but I was able to do it. Let's put this back up to 5 million here. And that's why everybody's IRR is different than the project because it has all these different assumptions about when they come in, which I thought was really cool to help with strategy and planning. This just does a running count so you can see the percentage when investors come on, the equities diluted, or the initial equity that's available there that's left. We've only got 3 here, so that's what it ends up being for the rest of the time. So here's how I did it. So distribution details. So you can see here, this is the main chart I had to build. So look at, you can see each one here has a period, and here's their initial investment. So this is always period zero initial investment. And then, so like round two doesn't actually come in till the third year. So their period one is actually going to be cash flows from the third period. So look at this actually sums up, if I expand this, this actually sums up cash flows for round two based on the year being year three. And you can see 4, 5, and this is okay. This goes up 6, 7 because there's obviously no 6 or 7, so that's why you see zeros here. But that's the only way to make the IRR actually make sense. And so we can take into account timing and different things, which is huge for strategy. Again, as I said, as I mentioned, you can see if other one invested in April 2020, which is in year two. So therefore, year two is actually their first period. So we're going to sum up everything for year two. That's their period one. Then we're going to sum up everything for period four or three. So that's their period two, and then their four is actually their period three, and then the fifth period, which is when we do possibly. Well, we don't have an exit here. Oh wait, we do have an exit. So that's where they get a little bit more of the cash flow. And you can see I confused myself because this actually, so this the cash flow, since this is year five for this other one, this is where they're actually getting that whatever the share of the exit proceeds is, and then this is for seed round one, and this is for the remaining equity. So that these three are actually all in the last year. But that's the only way to do it that I could see to make it actually make sense. Here's a general just discounted cash flow analysis, and so this is the same thing as this shape. It's just discounting it, and then you could have see a net present value with the proper period being discounted because obviously this is period one for that, but that's actually in the second year, so it's not the same as what period one is for seed round one, which is actually zero because they invested. There was actually no cash return in period one, so they don't get anything until period two. Um, so to do net present value, you just sum up the discounted cash flow, discount value of all the future cash flows, and then reduce it from their initial investment. Now here's the cool part, and this is why this all ties in. Look at the cap table. look at the IRR for seed round one, 64%. So the IRR is defined as what makes the net present value of the future cash flow zero. So look, I'm going to copy that. If I paste it into our discount rate, you can see the seed round one goes to zero, net present value equals zero. That's how you can tie out and check to make sure, everything's all good. Let's do another one. Let's do this round two is actually 94%. So if we apply the 94% to them, their net present value is now zero, which means you would have to discount their future cash flows by 94% in order to make the future cash flows equal to the initial investment. So that's good. You want that discount rate that has to be applied to be higher. That means the cash flows are higher relative to your initial investment, and hence that's why people like to use internal rate of return, because it's solving for that tough. It's a tough thing to manually do. You can't really manually do the math on it. Well, you can, but it's really hard. So I'll put this back to 16%, and you can see positive net present values here. Um, and these are just this is all flowing from after tax cash flow, and you can see that this is the initial investment schedule, and then this is the cash flow that's coming into each over time. And so those are used as the basis to build all these other summaries. Never did this before. I'm really happy with the final results. I think it's one of the most useful logical displays I've ever done. So this is really cool here. If we go on to the executive summary, this is your high level of like what the actual project is going to do. So you've got your uh, different revenue types here: total revenue, cost of goods sold, gross profit, G&A, R&D, marketing, EBITDA, just all your standard line items I'll put in one spot per year. Just kind of covered or debt service coverage ratio. This is basically what your EBITDA is relative to the amount of debt you have to pay. Then you've got average EBITDA per listing. So this is how much, based on the total listings for that year and the EBITDA made in that year, this is how much you're making EBITDA on every listing. And it's negative, obviously, for EBITDA is negative. Then we've got other cash flow items. So you've got Capex in here. This is all dynamic. You've got debt service, investor funding, and to make this clean, I'm going to put the exit year in the final month so it looks visually cleaner. Investor funding, startup costs, proceeds from the exit, loan proceeds coming in, loan being paid back. This happens as soon as the exit is put in. If there's no exit or NA, then there's no loan paid back. Taxes, which is going to be hard coded on a monthly basis in the monthly detail, and then pulled through to the annual summaries. And you got cash flow after tax, and then your cumulative cash position. And this is obviously assuming this 90 or this your 1.8 million is the actual money you have to put in. So obviously you wouldn't have a negative cash balance, but you'd be basically you would get to a cash balance of zero in one of the months, if assuming your forecast was 100% accurate and everything happened like you think it is. But obviously that's not the case. But that's just how the logic is working on defining what your actual equity needed is, because it's higher than your initial investments, less your funding from investors and in financing, because you're running burn for a little bit. So there's burn in the first 2 years, and that's causing you to actually need a little bit more money than just the initial startup costs. Then we've got charts here: revenue, gross profit, EBITDA, standard. You've got expense summary. I just did the main expenses. We've got 4 of them. I have not included debt service in here. These are just these are all operational. I'm actually put that operating expense summary. Then we've got more visual. So I've done, revenue by type. So there's 4 types, but only 3 of them are visible because the advanced placement revenue is really small based on our assumptions. Then you got the same exact chart here, but it's just showing the percentage breakdown of each one instead of the total dollar amount. Then we've got a breakdown. So this is over 5 years, the total cash, the other cash items. So these are, Capex, proceeds from the exit, loan proceeds, debt service, investor funding, loan payback, startup costs. So this is an interesting kind of breakdown of some things. We've got your total expense items on a 5-year total basis, so cost of goods sold, G&A, R&D, marketing, pretty even distribution there. We've got your cash flow post-tax, so you can see when you start to get cash flow positive. You've got your EBITDA per listing, which I like that metric, so I added it here as a chart per year. We've got our monthly and cumulative cash flow, so you can see every month you have cash flow, and then that accumulates, and you can see you finally start to make some positive uh, cash positions here in the 4th year and 5th year, and then this is obviously the exit. Investor and owner cash in and out. So this is a nice thing to show, what cash you actually have to put in, and then over the 5 years, how much are you actually getting back? And I thought that was a cool chart, and it shows each round and the remaining equity. We've got percentage ownership, so you can see the main one up here is the first primary equity position of like probably the owners, and you see they sell theirs to investors as investors come on. And you see the starter rate at the beginning, so they got 17% from the start. Other one started here. Round 2 started here. And so every time you sell some equity, this will obviously go down and these go up. So it's just a monthly summary of that. Then we've got our annual IRR versus the annual ROI for each one. And like I said, because it's the timing, I've allowed for timing differences. These will be different for each person. Then we've got cash flow distributed per entity per year. So this is showing um, who's getting what each year, and because of the exit. Now, if I remove the exit, you can see the other years a little bit easier. Yeah, a little bit. But this is the 5th year, so much more than, well, actually there's no distributions in year 1, but year 2 is a tiny bit, and then you start to grow. But obviously all these will change when you put in your assumptions for your own situation. We've got a break even. So this is just looking at the annual fixed costs and then the total variable cost for that year, and then coming up with how much actual revenue you need to make to break even. You see year 1 you need 553, and clearly year 1 we only have 368,000, so that's why, hey, there's a loss. Now once we broke over, you can see year 2 is break even is 553, or sorry, 782, and we've made 908, and you can see, oh, we got profit that year. So that's interesting. Now this, I pulled this chart over from my other thing, so I'll make sure. Okay, so this is doing, yeah, that's a break even, that's right. Okay, then we have our monthly and annual P&L. So these are pretty long. I've grouped them up so you can kind of collapse these and see the totals a bit easier, but still it's 200 rows long. Um, but you can see it's just showing you how all the calculations happen on a monthly basis. So you can see these are the listings on the marketplace. These are actually the transactions. So the transactions are less, assuming not all listings are transacted. And we have to separate them because we're assuming you might or might not want to have a fee on each listing as well as a fee on the transaction that's separate. And obviously you can zero the assumptions out if that's not the case, and it'll just be, it'd be 8,000, and then the fees go. So this is the value of the listings, and then based on that value, you have fees on the listing, which is, here's your actual revenue that the facilitator marketplace business would take. So they get a fee on the listing value, which is a fixed for all 3 types. So that's just, we can just multiply the total value times that percentage, which is done dynamically with H lookups. Then we get the value of transactions, which is a little bit less since we're not saying everything listed sells. And based on that, you've got fees for buyers and sellers, and then the total fee on transactions. Again, this is revenue for the facilitator. Then we've got advanced placements, which is some small percentage of the total items sold per month. And that results in some amount of money. You see it gets up to like 15,000 when you've got about $40 million of listings a month. So, and obviously that those proportions and stuff would all change if you change the assumptions. Then we've got total fee revenue. Then we've got ad revenue. So here's your visitors, monthly page views, your cost per thousand, then the revenue there. Then we've got our grand total revenue per month over 5 years. You've got your cost of goods sold, fixed, variable. That breaks down to total cost of goods sold. Then you can derive your gross profit. Then you've got your total G&A expenses, R&D, operational, marketing, and then we've got total marketing. Then you can subtract all those high-level lines out to get your EBITDA, earnings before interest, tax, depreciation, amortization. After that, we've got Capex. Then we've got debt service. Then we've got investor funding. Then we've got startup costs. Then we've got exit of the business, proceeds from the exit, if applicable. You get your loan proceeds. You've got your loan payback. Then, after all that, we can calculate cash flow. Then we could hard code in if you want to take into account a tax provision per month where it makes sense. You can do that. Its taxes are so complex that for the purpose of this model being usable by a large amount of people, I just made it. You could put in a monthly amount here. Say it's 500,000. Well, let's do it on a profitable year. So let's go over here. Let's say it's 500,000. That then turns a cash flow negative for that month, and it flows down through. Now, what's interesting, you can see so then we have cumulative tax cash flow. Then we have your actual cash balance, assuming that minimum equity injected. Remember I said it was going to be zero in some month. You can see in month 23 it actually gets to zero. So this means you've ran through all of your available cash, and you're now at zero. But then, because we solved for this 1831, which I think is what it is for the main one. Yeah, 1831. So now that is the worst position you'll ever be in, and then you start actually making a profit after that. And that's all that will change. So as you change assumptions, this is wherever this is will move around, but that's how we're solving for the equity requirement that's needed beyond all your investor funding and everything else. Then we've got the cool calculations here, EBITDA per listing, per transaction. You can pick whichever one. I think on the front of it I did EBITDA per transaction. Oh, no, I did it per listing. So that's the monthly. Now the annual is the same exact thing as the monthly, but it's obviously on an annual basis, and that's how I can then easily solve for the executive summary and the high level items. Just pull from this. Okay, well that's every tab. Um, Again, this is first time I've added a cap table and distribution details. I think it's really cool, super dynamic, and I hope you guys enjoy. This is smarthelping.com.